common right now to find somebody who has paid maybe $60,000 or $65,000 for a very high-end pickup truck. Well, even the average pickup truck now is going to be crossing over that $50,000 barrier.
What if the help you were promised was the very thing that's about to take your car away? In 2020, loan freezes were sold as relief. No income checks, no questions asked. But those easy approvals opened the floodgates to risky loans. And now, 20,000 cars a day are vanishing from driveways. This isn't just bad debt, it's a financial time bomb. Which borrowers are getting blindsided first? Why are even current on-time payers at risk? And what will happen to the market when this wave hits full force? Because by the time this is over, you'll see. It's not just a repo crisis. It's a trap millions are already caught in. The loan freeze that lit the fuse. It began with a decision that, at first glance, seemed compassionate. In the early months of the pandemic, as jobs vanished and whole industries went dark, both government officials and major lenders moved quickly to prevent a wave of defaults. They introduced loan freezes, payment deferrals, and relaxed application requirements, all in the name of keeping people in their homes and cars. But buried within that emergency relief was a choice that would come back to haunt the very people it was designed to help. Banks were told to halt proof of income checks, residency verification, and even employment confirmation. What was intended as a lifeline became a blank check for risky borrowing. Before the pandemic, a buyer walking into a dealership would be asked for pay stubs, rental agreements, and a credit history that could withstand close inspection. By mid-2020, that scrutiny had disappeared. Loan approval rates climbed well above pre-pandemic levels, not because the economy was healthier, but because lenders were told to keep the credit pipeline open at all costs. People without stable jobs were suddenly driving off in vehicles they could not afford in the long term. The industry had traded short-term stability for long-term instability, and no one seemed to be thinking about the bill that would eventually come due. As the months passed, this invisible debt bubble swelled. Borrowers got used to making no payments, while lenders got used to counting on government-backed relief. Both sides were lulled into a dangerous complacency, and once the freeze melted away, the real disaster began to take shape. When the credit gate blew wide open, with traditional safeguards removed, the auto loan market transformed almost overnight into a playground for risky lending. Dealerships, suddenly starved for foot traffic in the early lockdowns, saw the relaxed bank standards as a green light to push sales harder than ever. Without proof of income requirements, buyers who previously would have been denied walked away with new cars and long-term loans. Subprime lending, which had been carefully monitored before, began to surge. Between 2019 and 2021, the share of auto loans going to subprime borrowers rose sharply, creating a fragile foundation under an already unstable market. On the sales floor, the change was electric. Salespeople who once dreaded the phrase bad credit now knew they could get almost anyone approved. Customers came in with no verifiable employment, sometimes even admitting they were living off temporary benefits, and still drove off in vehicles with 5, 6, or even 7-year terms. The credit gate had not just opened, it had been blown off its hinges. Inventory moved, commission checks grew, and few wanted to question whether these buyers could keep up with their payments once the world returned to something like normal. This sales frenzy may have kept dealerships afloat in the short term, but it was building a time bomb in the auto finance system. And when the fuse is burning, it is only a matter of time before it reaches the powder. But even this flood of risky loans was not the final trap. If you're feeling the weight of what's happening so far, hit that like button. It helps more people see this before it's too late. And I want to hear your story in the comments. Have repossessions touched your family, friends, or community? Your voice could help someone else prepare. The stimulus mirage. For many borrowers, the illusion of affordability was built on the scaffolding of government stimulus. Monthly deposits padded bank accounts, making it seem possible to take on car payments that, in reality, far exceeded a sustainable share of income. Payment-to-income ratios ballooned as families spent more than they ever had on vehicles, trusting that the good times would last. But stimulus checks were always meant to be temporary, and when they stopped, the mirage dissolved overnight. Households that had once looked stable on paper suddenly faced a harsh reversal. Median household income slipped back to pre-pandemic levels, but the car payments remained just as high. For some, that meant a $1,000 payment on a pickup truck or SUV when their actual monthly income had fallen by a quarter or more. The result was a rapid shift from surplus to deficit. Families that had been able to cover their bills during the stimulus period now found themselves choosing between the rent and the car note. As the savings cushions from those temporary checks were drained, delinquency rates began to rise. Borrowers who had never missed a payment before were falling 30, 60, even 90 days behind. Lenders tried to offer short extensions, but the structural problem remained. The income boost that had made these loans possible was gone, and there was no replacement. And just when wallets were thinning, the interest rate hammer came down. The interest rate hammer. If the stimulus ending was a slow leak in the tire, the Federal Reserve's aggressive interest rate hikes were a blowout on the highway. In an effort to curb inflation, policymakers raised rates at the fastest pace in decades. By the end of 2024, the average annual percentage rate on new auto loans had climbed several points from its 2021 levels. For buyers already stretched to their limits, that increase meant hundreds of extra dollars each month. For those looking to refinance, it meant finding the door slammed shut. Higher interest rates did not just make new loans more expensive, they magnified the pain for anyone carrying variable rate debt. Borrowers who had scraped by with low-rate loans during the pandemic now faced ballooning payments they could not match with stagnant wages. The math simply stopped working. Incomes were flat, expenses for essentials like food, rent, and fuel were up, and car payments were eating an ever larger share of the budget. Many families were paying more for their vehicle than for their housing. For lenders, the shift was just as jarring. The higher the rates climbed, the more the pool of qualified buyers shrank. That meant fewer new loans to replace the ones going bad, and more repossessions as people fell behind. The very tool meant to stabilize the broader economy was accelerating the unraveling of the auto loan market, and what followed was a repossession tsunami like the country had not seen in decades. 20,000 cars a day. The numbers are staggering. In the United States today, more than 20,000 vehicles are repossessed every single day. That figure eclipses even the darkest months of the 2008 financial crisis, when lenders were hauling away cars at a rate once thought to be unsustainable. Back then, the repossession industry struggled to keep pace with the sudden surge of defaults triggered by a housing collapse. Now the problem is even larger, and it is unfolding against the backdrop of a much more interconnected economy. When repossessions happen at this scale, the consequences go far beyond the individual owners. States with high commuting populations, such as Texas, Florida, and California, are reporting the highest volumes, not because people there are more reckless borrowers, but because their economies rely heavily on car ownership for basic survival. In these regions, a lost vehicle often means a lost job, which in turn means a lost income, which then feeds back into further defaults on other loans. It becomes a self-perpetuating cycle of financial damage that accelerates with every tow truck. Lenders know that each repossession represents a loss they are unlikely to fully recover. Even if the car is resold at auction, the price rarely covers the outstanding balance, leaving the bank to absorb the difference. Multiply that by thousands upon thousands of vehicles, and the impact on financial institutions becomes a slow-motion bleed. But statistics cannot capture the wreckage left behind in people's lives. Families without wheels. When a family loses its only car, the fallout is immediate and brutal. Without transportation, getting to work becomes a daily challenge, and in many parts of the country, public transit is not a realistic alternative. Parents who once dropped their children at school or daycare find themselves scrambling for rides from friends or neighbors. App-based ride services like Uber or Lyft can fill the gap for a few days, but the costs add up quickly, eating into already strained budgets. For low-income households, a repossession can be the tipping point into long-term poverty. One missed day of work can mean a smaller paycheck. 1 week without reliable transport can mean job loss entirely. Once income dries up, catching up on any overdue bills becomes nearly impossible. The damage ripples out in unexpected ways: missed doctor's appointments, delayed grocery runs, and reduced access to educational opportunities for children. Even the psychological toll is significant. Losing a vehicle often feels like losing independence itself. In rural communities, the situation can be even more severe. Long distances between home, work, and essential services make a personal vehicle a non-negotiable necessity. Without one, families face isolation, both economically and socially. For many, the repo truck does not just take away a car, it takes away the ability to function in the modern world. And while families scramble, another group is fighting a very different battle: the dealer's dilemma. Car dealerships are caught in the middle of this crisis. On one hand, the influx of repossessed vehicles is swelling the used car supply, theoretically offering them more inventory to sell. On the other hand, high interest rates and stricter lending standards are choking off the pool of eligible buyers. A cheap car on the lot means little if the customer cannot get financing. Dealers who once relied on rapid inventory turnover are watching cars sit unsold for weeks or months. The result has been a pivot toward the so-called cheap cash car market. Older vehicles sold outright without financing. These cars are moving quickly, often to buyers who have already suffered a repossession and cannot qualify for traditional loans. But this shift is not enough to offset the losses from stalled new car sales. Manufacturers are pressuring dealerships to move fresh models, yet the appetite among consumers is weak when monthly payments stretch into the 4-digit range. Some dealers are even bypassing the retail market altogether, selling repossessed vehicles in bulk to auction houses just to clear space. This keeps the cash flowing, but erodes potential profits. The industry's once reliable rhythm, trade-ins feeding into used sales, sales while new models roll off the lot has been replaced by a jagged, unpredictable pattern. And the shockwaves do not stop at dealership doors. Collateral damage in the service economy. Beyond the sales floors and repossession yards lies a wider network of businesses that depend on the steady hum of car ownership. Mechanics lose work when customers no longer have vehicles to service. Parts suppliers see orders dry up. Gas stations sell fewer gallons. And with that decline comes reduced sales of the coffee, snacks, and other impulse items that keep their margins healthy. Insurance agents lose clients when coverage is canceled after a repossession. And body shops see fewer repair jobs as the number of insured vehicles falls. These secondary effects can quietly destabilize local economies. In small towns, a single garage closing its doors can put several people out of work. In larger cities, a downturn in car-related spending can strain municipal budgets that depend on fuel taxes and registration fees. The interconnectedness of the auto sector means that every repossession sends a faint tremor through dozens of related industries. And when those tremors are happening 20,000 times a day, the cumulative shake can be enormous. For the service economy, this is not just a temporary slowdown, it is a structural shift. Businesses built on the assumption of steady car ownership are being forced to adapt, and some will not survive. And now those ripples are starting to pound on Wall Street's doors. Banks on the brink. For lenders, every repossession represents more than just a disappointed customer. It is a financial wound that is slow to heal. When a loan turns into a non-performing asset, the bank must write down its value, a process that erodes profitability and forces executives to rethink their risk models. Before the current crisis, non-performing loan ratios at major auto lenders hovered at historically manageable levels, often below 2%. Today, those ratios have jumped dramatically, with some institutions reporting double the delinquency rate they faced just a few years ago. The problem is compounded by the fact that repossessed vehicles rarely fetch enough at auction to cover the outstanding balance. Depreciation has accelerated in certain vehicle segments, especially for models that were heavily marked up during the pandemic. Lenders are left holding the shortfall, and when this happens tens of thousands of times across the country, it begins to threaten the stability of entire portfolios. Some smaller regional lenders, more heavily exposed to auto debt, are already seeking outside capital infusions to shore up their reserves. This financial strain is pushing banks to make difficult decisions. In order to protect their balance sheets, they must not only absorb current losses, but also prevent future ones. And their survival plan means a harsh reality for borrowers: the return of harsh credit rules. In the wake of mounting losses, lenders are tightening their standards in ways that harken back to the pre-2008 era. Minimum credit scores for loan approval are climbing, with some banks refusing to finance buyers with anything below the mid-600s. Loan-to-value ratios are being trimmed, meaning borrowers are expected to bring larger down payments to the table. Terms longer than 5 years are becoming rarer, as banks try to reduce exposure to depreciation risk. For consumers, these changes mean the era of easy credit is over. Those who once walked into a dealership with marginal credit and drove away in a new car are now being turned away or offered loans with prohibitively high interest rates. The approval rate trends tell the story. Compared to the months immediately after the loan freeze, current approvals are down sharply, especially in the subprime segment. This not only restricts access to vehicles, but also puts downward pressure on the entire auto sales ecosystem. For automakers and dealers, these stricter lending rules are like a sudden storm on the horizon. Sales forecasts that once assumed a steady flow of approved buyers are being shredded in boardrooms across the industry. And these stricter rules are triggering panic in automaker boardrooms. Automakers facing an unwanted inventory glut. For manufacturers, the repo crisis is a double-edged sword. On one side, the influx of repossessed cars is adding supply to the used market, which competes directly with new vehicle sales. On the other side, stricter lending standards mean fewer consumers can qualify for the financing required to purchase new models. The result is swelling inventories at factories and distribution lots, a problem that automakers have not faced on this scale in years. Quarterly reports from several major manufacturers reveal a growing backlog of unsold vehicles, prompting production cuts and, in some cases, delayed model launches. Incentives, once reserved for clearing out older inventory, are now being deployed to stimulate sales of even the newest releases. This is a costly strategy, as deep discounts eat into already thin margins, but for many automakers, it is seen as the only way to keep assembly lines moving and avoid full-scale shutdowns. The situation is especially precarious for manufacturers that rely heavily on the North American market. They cannot simply divert all excess inventory overseas, as global demand is also under pressure. The mounting tension in corporate headquarters is clear. The longer this glut persists, the more drastic the measures will need to be. But the tremors are not contained to American soil. Global finance feels the heat. The United States auto loan crisis is not staying within its own borders. Many foreign banks, especially those with branches or subsidiaries operating in the U.S., are exposed to the same wave of repossessions. These institutions must now adjust their global balance sheets to account for unexpected losses. In some cases, foreign lenders had bundled U.S. auto loans into investment products sold overseas. As those loans sour, investors in Europe, Asia, and beyond are beginning to feel the pinch. Automotive exports are also taking a hit. When U.S. demand for new vehicles falls, it ripples through global supply chains. Foreign factories producing parts or fully assembled vehicles for the American market are scaling back production, leading to layoffs and localized recessions in manufacturing-heavy regions. Currency markets, too, are reacting. As the U.S. auto sector weakens, some foreign currencies tied to automotive exports are experiencing volatility. This interconnected financial ecosystem means that a repossession crisis in the United States can contribute to credit tightening and market instability abroad. It is a reminder that in the modern global economy, no sector operates in isolation, and at home, the political storm is about to erupt. Washington's blame game. The repo surge has become more than an economic problem. It is now a political weapon. On Capitol Hill, hearings are being convened to investigate the causes, but the tone is anything but neutral. Lawmakers on one side frame the crisis as a predictable result of reckless lending and a lack of consumer protections, calling for stricter regulations on auto financing and greater oversight of repossession practices. Their counterparts argue that government intervention during the pandemic distorted the market in the first place, creating an artificial boom in car sales that was destined to collapse once stimulus and loan freezes expired. Election year dynamics have only heightened the rhetoric. Candidates are using the crisis to draw sharp contrasts between their visions for the economy. Some are promising sweeping reforms that would cap interest rates, mandate longer grace periods before repossession, and expand access to public transportation. Others are focusing on deregulation, claiming that loosening manufacturing restrictions and streamlining lending rules will stimulate demand and pull the industry out of its slump. Behind closed doors, proposed legislation is being drafted, ranging from targeted consumer relief programs to broad economic packages. But as with many politically charged issues, the pace of actual change is slow, and in the meantime, the people directly affected continue to struggle. And while lawmakers posture, the labor movement is sharpening its demands. Labor movements push back. Unions and worker advocacy groups have seized on the repossession crisis as evidence that wages have not kept pace with the cost of living. Leaders point to the fact that many repossessed vehicles belong to working-class families who were making payments faithfully until inflation, interest rate hikes, and stagnant wages combined to squeeze them dry. Public statements from several large unions have called for significant wage increases, arguing that without them, even modest financial setbacks can push workers into default. Some unions are also pushing for more creative solutions. Proposals include employer-subsidized transportation programs, interest-free car loans for employees, and expanded use of company shuttles in regions with limited public transit. In industries where personal vehicles are essential, such as construction, delivery, and healthcare, these ideas have gained traction as a way to prevent future transportation-related job losses. Strike activity has also seen a modest uptick, with some labor actions explicitly linking contract negotiations to transportation security. The message is clear: reliable access to a vehicle is not a luxury for most workers. It is a prerequisite for employment. This framing has resonated beyond traditional union strongholds, capturing public sympathy and sparking discussions about the role of employers in safeguarding mobility. But on Main Street, consumers are quietly rewriting the car ownership rulebook. Consumers rewrite the rulebook. Faced with the twin challenges of high financing costs and an uncertain economic outlook, American consumers are changing the way they approach car ownership. Rideshare services, once seen primarily as a convenience, are now becoming long-term transportation solutions for urban residents who want to avoid the risk of loan default. Car subscription programs, offering access to a fleet of vehicles for a monthly fee that includes insurance and maintenance, are gaining popularity among younger buyers who value flexibility over ownership. Cash purchases, particularly for older used cars, are also on the rise. Many buyers who have experienced a repossession are unwilling to go back into debt for a vehicle, even if it means driving something less flashy or more worn. Meanwhile, certain leasing markets are shrinking as consumers shy away from agreements that can be as binding and risky as traditional loans. This shift is changing dealership strategies too. Some dealers are experimenting with hybrid sales models, offering subscription-like packages alongside conventional sales. Others are partnering with rideshare companies to offer fleet vehicles directly to drivers. While these trends are still developing, they signal a potential long-term change in how Americans think about mobility. And in this chaos, a new set of winners and losers is emerging. If this opened your eyes, make sure you subscribe right now, because the next wave is coming fast, and I'll be breaking it down before most people even see it coming. Hit that bell so you're first to know what's next. Well, there's still time to act. Winners and losers of the repo economy. Not everyone is suffering in the current climate. Repo auction companies are experiencing a boom, with their lots filled to capacity and bidding wars breaking out over desirable models. Hedge funds and investment firms are snapping up large batches of repossessed vehicles at discounted prices, betting they can resell them at a profit once the market stabilizes. Salvage yards, too, are benefiting from the influx, dismantling vehicles for parts that are increasingly valuable amid ongoing supply chain issues. On the losing side are the borrowers whose vehicles are taken, often leaving them without a means to earn a living. Dealers dependent on steady new car sales are also struggling, squeezed between manufacturer expectations and the reality of fewer qualified buyers. Lenders, while able to recover some losses through auctions, still face the challenge of shrinking loan portfolios and stricter regulatory scrutiny. The balance of power in the auto economy is shifting. Those positioned to profit from volatility are making bold moves, while those dependent on stability are bracing for more turbulence. The long-term outcome will depend on whether the broader economy can absorb the shockwaves, or whether the repossession surge marks the start of a more permanent transformation in how Americans move, work, and live. And what happens next is a question no one can answer with certainty. Everything you've just heard isn't the end. It's the warning shot. The next few months could decide whether you keep your car or lose it overnight. Subscribe now and turn on notifications so you don't miss the updates that could protect you. Share this with someone who needs to see it before it's too late, and let's get ahead of this storm together.